Before you dive into any chart, setup, or trading strategy, you need to understand what the market is actually trying to do. Most traders jump into indicators and entries without ever learning the underlying mechanics of price, and that's why most traders fail. In reality, the market isn't random, it's organized chaos. It's a constant auction, buyers and sellers competing to agree on value. Once you understand this dynamic, you'll start seeing the charts differently. In this video, we are going to break down auction market theory, a simple but powerful model that explains why price moves, how value is discovered, and how markets rotate between balance and imbalance. Let's start by looking at what fair value actually means and why this bell curve isn't just a stat from high school maths, it's the foundation of every price chart you've ever seen. When we talk about financial markets, we are essentially talking about a continuous two-way auction between buyers and sellers. The goal of this auction is simple: to facilitate trade and establish what's called fair value for any given asset. But how exactly do markets find this fair value? Markets move price up and down, trying to discover that area where most buyers and sellers agree, where trading volume is highest. On a chart, this fair value usually appears as a tight range with concentrated trading activity, and statistically, this often shows up as about 70% of total volume, closely matching one standard deviation from the mean in statistics, around 78.26% of data. Think of this as a curve bell, or what statisticians call a normal distribution. Most activity clusters around the center. This is fair value. On either side, activity decreases significantly as price moves further away from that fair value, indicating fewer buyers and sellers agreeing on those prices. The market continually swings between these extremes, always seeking balance and equilibrium. Let's simplify this with a real world example. Imagine a house auction. The auction begins at a fair starting price, let's say around 400,000 US, where buyers and sellers initially agree on fair value. But suddenly, many eager buyers jump in aggressively, outbidding each other. Demand surpasses supply, creating a buying imbalance. Price rapidly shoots up, leaving fair value behind as buyers compete. Eventually, price reaches a point, let's say $450,000, where buyers hesitate and sellers are now strongly motivated to sell, considering this price as fair value. Aggression balances out again, and the auction stabilizes. This new stable area becomes the new fair value zone. Now imagine a sudden negative event, perhaps bad news about the neighborhood emerges. Sellers become aggressive, quickly outnumbering buyers. A selling imbalance forms, pushing prices down sharply. Price falls rapidly as sellers dominate, searching again for a price low enough to entice buyers to step back in. Let's say around $425,000 in this hypothetical example. Eventually, price reaches this lower level where buyers regain confidence. Aggression balances once again, and the market forms yet another new fair value. This constant cycle of moving from fair value into imbalance through price discovery and back into fair value is the essence of auction market theory. Understanding this dynamic, how price doesn't move randomly but instead moves methodically through balance, imbalance, and discovery, is crucial. As traders, knowing this helps us gain clarity on why markets behave the way they do, enabling us to trade with conviction rather than emotion. Let's take a look at how the auction market theory works in real time. On the lower time frames, I would say anything from the 1 minute to the 1 hour time frame. Usually markets range 70 to 80% of the time. And this range is the fair value where the bidders or buyers and the sellers are at equilibrium, as we talked about in the earlier examples. Let's consider two types of traders: higher time frame and lower time frame traders. You can assume higher time frame traders have orders they would like to get filled over a longer period of time, and they leave their orders in the order book, i.e. the bids and the asks for a lot of time, which could be hours to days. In a typical market, when price is confined within a range, it is because these higher time frame traders place large limit orders at extremes, as shown by the red boxes here. The lower time frame traders typically have smaller size on their limit orders, and those are placed and filled or removed in a very short period of time. This meaning it is not necessary for price to tap range highs and lows every time in a perfect manner, but it can be a haphazard in nature depending on whether the market buyers and sellers are showing aggression or not. In our first push towards range highs here, the market buyers could not push through the lower time frame orders, and price reversed as all the buyers and sellers were matched against each other, and the next market sell order was filled at a much lower limit order in the red box below. The same process continues for multiple tests of the range lows and highs, and this is why the range forms. Here we can see price reaches the extremity but reverses as it hits the higher time frame traders. In this instance, the lower time frame traders stepped in. Also in this instance, and here we can see it's getting tighter and tighter and tighter. We have this final touch at the higher time frame traders for a return to the other extremity of the range, where lower time frame traders step in a lot earlier for price to break out here or move from fair value, which is a balanced state, to an imbalanced state, or simply said, break out from the range. There are usually two things that can happen. One, limit orders from higher time frame traders are removed, which allows smaller market orders to form a new range at a new fair value at higher prices. Or two, the market orders get so overwhelming that over time the small market orders eat through the large chunk of limit orders. Once price breaks above or below, there are no large limit orders, and hence the aggressive party like market buyers or sellers are in control. In the bullish example, this means that we break above and keep moving higher till the buying stops or we reach another area of large limit sell orders where the auctioning process begins all over again. Using the Solana chart, let's take a look at a real example of auction theory. At this high, we can see that Solana is ranging, or in a state of fair value, where buyers and sellers are in agreement. We then have this sell side impulse or supply defeating demand before price ranges again, which is another state of fair value. We then continue with an impulsive leg lower, sell side, where supply defeats demand again lower. From there, we find another range or a state of fair value. We then continue to break lower on the sell side before finding fair value again. This process continues quite visually, continuously. So if you enjoyed this video, subscribe and hit the bell so you get a notification when the next video is live, and like and comment. It means a lot. It lets me know you guys are enjoying these videos. Happy learning, and I'll see you guys in the next lesson.